Hello friends, welcome to Akulmac Live. Is the Indian stock market heading for a slump or a surge? Let's get a deep dive into conflicting signals shaping the Indian economy right now. We will break down the latest GDP growth data, analyze why some analysts are predicting a muted September, and explain the powerful role of the domestic investors, which are also known as DIIs, and the recent GST overhaul. Let's go. Hello everyone and welcome back to our channel. I'm your host CK, and today we are diving deep into one of the most intriguing and often perplexed economic stories of our time, the Indian market. If you have been watching the headlines, you know that the India is a land of incredible contrast and enormous potential. But lately, when it comes to its economy and stock markets, there are fascinating puzzles emerging. On one hand, we are seeing some truly impressive numbers, robust GDP growth, strong domestic investor confidence. On the other hand, there are whispers, even shouts from analysts predicting a potentially muted period ahead. So, the big question on everybody's mind is, will India's impressive GDP growth ultimately win out over the mixed signals, or are we heading for a period of adjustment? Today, we are going to dissect this very puzzle, explore the key drivers, and help you understand what it is, what it means for India's economies, India's future, and your investment decisions. Let's start with the good news, and there is plenty of it. India's economy is roaring, having clocked an impressive 7.8% GDP growth in the most recent quarter. This isn't just a number, it reflects the real activity on the ground. This growth is being driven by several factors: strong domestic consumption, robust government spending on infrastructure, and resurgence in the service sector. India's unlikely many developed economies have a huge, young, aspirational population, which translate into an ever-growing consumer base. What makes this growth particularly resilient to the increasing strength of the domestic institutional investor, or DIIs? For years, the Indian market was heavily influenced by the foreign institutional investors, which are also known as FIIs. When FIIs pulled out, the market often wobbled, but now we are seeing a significant shift. DIIs, things like pension fund, mutual fund, insurance companies are pouring record amount of money into Indian stock markets. They are acting as a crucial counterbalance, providing a stable foundation even when the global sentiment might be shaky. Its domestic firepower is a game changer, indicating a maturing financial market and growing belief among the Indians in their own economic story. This isn't just about big institutions either. Retail investors, empowered by accessible trading platforms and financial literacy campaigns, are also playing a much bigger role. They are seeing the long term potential and committing their savings, which adds another layer of stability and depth to the market. So, on the one side of our puzzle, we have robust growth and increasingly self reliant market driven by its own citizens. Now, let's flip the coin and look at the mixed signals, the pieces of our puzzle that suggest a more cautious outlook. Despite the strong GDP numbers, some analysts are predicting a potentially muted September or even a slowdown in the near future. Why? One major factor is the global headwinds. The world economy is not as robust as it once was. High inflation in major economies, continued interest rate hikes by central banks like the US Federal Reserves, and ongoing geopolitical tensions are all creating a less favorable global environment. This can impact India's through various channels, such as slower export growth, reduced foreign investment, despite DII strength and potentially higher commodity prices, especially crude oil, which India heavily imports from other countries. Domestically, while consumption is strong, there are always concerns about inflation impacting purchasing power for certain segments of the population. Also, after a strong run, some sectors might be due for a correction, or investor sentiment could temporarily shift due to profit booking or a wait and watch approach ahead of major policy announcements or global events. Furthermore, a significant portion of the recent GDP growth has been attributed to the government capital expenditure. While this is excellent for long term infrastructure and job creation, some analysts look for more consistent private sector investment to sustain high growth rates. So, while the engine is running strong, there are external pressures and internal dynamics that warrant a closer look, creating a sense of caution among some markets observers. One of the biggest and perhaps most underestimated piece of our puzzle is the recent overhaul of India's goods and services tax or GST system. This isn't just a tweak, it's a significant structural reform that could have profound long term impact. The Indian government has implemented a major simplification, moving towards a two-slab system, which is 518, and there is one more which is for very few items, and that is 40. This is designed to streamline tax compliance, reduce the burden on businesses, and crucially, stimulate consumer demand. Think about it. A simpler, more transparent tax structure means less complexity for manufacturers and retailers, potentially leading to cost saving that can be passed on to consumers as lower cost. This is expected to be a major boost for sectors like fast moving consumer goods or FMCG and the automobile industry. For FMCG, lower effective tax and simplified logistics can make essential goods more affordable and accessible, especially in the rural market. For the auto sector, which has faced challenges recently, the GST changes could reduce the overall cost of vehicles, making them more attractive to buyers and potentially kickstart a new phase of growth. Simplified GST also encourages formalization of economy, bringing more businesses into the tax net, which in turn broaden the tax base and provides the government with more resources for development. This overall isn't just about taxes, it's about reshaping the business's environment, fostering ease of doing business, and ultimately aiming to put more money back into the hands of consumers and businesses, driving demand. This could be a powerful layer that helps GDP growth overcoming any lingering market uncertainties. So, with all these pieces of the puzzle laid out, strong GDP, resilient DIIs, global headwinds, and transformative GST overhaul, what does it mean for investors for India's economy path forward? Firstly, it highlights the importance of a nuanced approach. While some analysts may caution about short-term volatility, the underlying structural story of India remains compelling. For long-term investor, period of mixed signals or minor correction can often present attractive entry points. The sectors to watch closely given the GST overhaul and domestic consumption trends includes FMCG, a disposable income rise and goods becoming more accessible, consumer staples and discretionary items will see increased demand. Let's talk about automobiles. If the GST truly stimulates demand, we could see a rebound in auto sales benefiting manufacturers and ancillary factories. Let's talk about infrastructure. Government spending on roads, rails, and urban development will continue, creating opportunities in construction, cement, and related sectors. Now, let's talk about banking and financial services. A growing economy needs robust financial services, and as more people enter the formal economy, demand for banking, insurance, and investment products will rise. The key takeaway is that India is in a unique position. It is rapidly growing economy with strong domestic fundamentals that provide buffer against the global turbulence. The sheer size of its domestic market and its demographic dividend are powerful advantages. While the global factors and short-term market sentiments will always play a role, the structural reforms like GST overall are designed to enhance long-term growth and resilience. This isn't to say there won't be bumps in the road, but overall trajectory appears upwards. So, to revisit our initial questions, will GDP growth win over mixed signals in India's market puzzle? The answer isn't a simple yes or no, but rather a strong indication that the fundamental force of growth, particularly robust GDP and the increasing power of domestic capital, are formidable. While the short term caution is always wise, especially given the global uncertainty, the structural reforms and the demographic advantage places India in a strong position for sustained long term growth. The GST overall is a testament to the government's commitment to creating a more efficient and demand driven economy, and its impact will ripple through key sectors, potentially offsetting some of the more conservative market predictions. Ultimately, India's market puzzle isn't about finding a single static answer, but understanding the dynamic interplay of these powerful forces. It's a market that demands attention, nuanced analysis, and view towards its immense future potential. So, friends, what are your thoughts on India's market? Are you bullish or do you share some of the analyst caution? Let me know in the comments below, and I love to hear from you. If you found this analysis helpful, please hit the like button, share it with your friends and fellow investors, and don't forget to subscribe to our channel for more in-depth economic and financial insights. Thank you for joining me live, and I will see you again in the next one.